There's an old rule in finance that every trader learns on their first day. Never negotiate when you're desperate, because when the other side knows you need the deal more than they do, you've already lost. Right now, the United States Treasury Department is breaking that rule in the most spectacular way possible. For the past 3 years, Washington has been waging economic warfare against Beijing. Tariffs, export controls, sanctions on Chinese companies. The rhetoric has been relentless. China is our greatest adversary. We must decouple our economies. America will never bow to Beijing, but behind closed doors, something very different is happening. The same Treasury Department that publicly supports decoupling is quietly making phone calls to Beijing, not to threaten, not to lecture, but to beg, because the United States government needs to borrow trillions of dollars just to keep functioning. And there's only one country on earth with enough cash sitting in reserves to make that possible. Do you see the absurdity of this position? The United States is currently trying to contain China's rise, while simultaneously depending on Chinese capital to pay its own bills. It's like trying to evict your landlord while you're 3 months behind on rent. This isn't speculation. This is math, cold, brutal, undeniable math. As of December 2025, the U.S. national debt stands at $38.4 trillion. Let me repeat that, $38 trillion. The debt grows by approximately $6 billion every single day. That's $255 million per hour, $4.25 million per minute, over $70,000 every second. Where does that money come from? The Treasury has to sell bonds, government IOUs. They have to find buyers willing to lend America money at interest rates the government can actually afford to pay. For decades, this was easy. The whole world wanted U.S. Treasury bonds. They were considered the safest asset on the planet, but that world is gone. Today, we're going to examine the impossible position the United States has created for itself. We'll look at the numbers that keep Treasury Secretary Scott Bessent awake at night. We'll examine why America's traditional creditors are walking away. And we'll explore the deal that Washington is being forced to make with Beijing, whether they admit it publicly or not. Because if this deal falls apart, we're not talking about a recession. We're talking about a sovereign debt crisis in the world's largest economy. Let's start with Scott Bessent's problem. Bessent was sworn in as Treasury Secretary on January 28, 2025. He's a former hedge fund manager. He understands markets, he understands leverage, and he understands that the United States is in a leverage trap. Here's what he inherited. The U.S. national debt reached $38 trillion in late 2025, but the number itself doesn't tell the full story. What matters is the speed. Over the past year, the debt increased by $2.2 trillion. That's $6 billion per day, every day for an entire year. And the cost of servicing this debt in fiscal year 2024, the United States government paid $1.1 trillion just in interest, not paying down the principal, just interest. Let that sink in. $1 trillion in interest payments alone. That's more than the entire Defense Department budget, more than Medicare, more than everything except Social Security. And it gets worse. A huge portion of existing U.S. debt was issued when interest rates were near zero during the 2010s and early 2020s. Those bonds are now maturing. They have to be rolled over, refinanced at today's much higher interest rates. The average rate on new Treasury issuance as of late 2025 sits around 3.4%. Compare that to the 1 to 2% rates from just a few years ago. This creates a compounding nightmare. Not only does the government need to borrow new money to cover its annual deficit, it also needs to refinance trillions in maturing debt at higher rates. Approximately 33% of all publicly held marketable debt will mature within 12 months as of late 2025. The Congressional Budget Office projects that by 2026 interest payments alone will consume nearly 14% of all federal spending. By 2027, 14%. By 2028, almost 15%. So where does Bessent find buyers? Traditionally, U.S. Treasuries had 4 major categories of buyers. Foreign governments, countries like Japan, China, and oil exporters who would recycle their trade surpluses into U.S. government debt. The Federal Reserve, which during quantitative easing was the biggest buyer, creating money to purchase treasuries, domestic banks and financial institutions, and American households through pension funds and retirement accounts. Let's look at what happened to each of these buyers. Start with Japan. For decades, Japan was the largest foreign holder of U.S. Treasury securities. As of October 2025, Japan held approximately $1.2 trillion in U.S. government debt. But here's the problem. Japan has been under immense pressure. In April 2025, facing aggressive tariffs from the Trump administration, Japan sold over $20 billion in U.S. Treasuries in just 2 weeks, the largest 2-week sell-off in years. Why? Because Japan needed liquidity. They needed to defend their currency. They needed cash for domestic stimulus. And after being hit with 24% reciprocal tariffs on exports, Japan had to make hard choices. From January 2022 to January 2025, Japan reduced its total Treasury holdings by approximately $220 billion. That's not trimming. That's a strategic retreat. Now look at China. China currently holds approximately $689 billion in U.S. Treasury securities as of October 2025. That's down from over $1.3 trillion at its peak in November 2013, a drop of more than 47%. In October 2025 alone, China reduced its holdings by nearly $12 billion. This marked the continuation of a pattern. China has been steadily, methodically, reducing its exposure to U.S. government debt for years. In March 2025, something symbolic happened. China dropped to third place among foreign treasury holders, behind both Japan and the United Kingdom. The message was clear. Beijing is diversifying away from dollar dependence. But here's what most people miss. China, reducing from $1.3 trillion to $689 billion, is still China holding $689 billion. They didn't exit completely. They didn't dump their holdings in a panic. They managed a gradual, controlled reduction. Why? Because China understands something fundamental about leverage. When you owe the bank $1 million, that's your problem. When you owe the bank $1 trillion, that's the bank's problem. China owns enough U.S. debt that a rapid sell-off would hurt China almost as much as it would hurt America. It would crater the value of their remaining holdings. It would strengthen the yuan, making Chinese exports less competitive. It would destabilize global markets where China also has massive investments. So China is trapped in the same system, but they have more leverage than the United States wants to admit. What about Europe? The United Kingdom actually increased its holdings to approximately $878 billion as of October 2025, but much of this represents hedge fund activity through London, not the British government making a vote of confidence. European banks and governments are dealing with their own crisis. Germany entered a technical recession. Energy costs remain elevated. Growth is anemic. European institutions aren't in a position to significantly increase their treasury holdings. They're managing their own sovereign debt issues. Then there's the Federal Reserve. During the 2008 financial crisis and the COVID pandemic, the Fed became the buyer of last resort. They launched quantitative easing programs, creating trillions of dollars to purchase Treasury securities. But that era is over. The Fed has been doing the opposite, quantitative tightening. They've been allowing their Treasury holdings to mature without replacement. The Fed's balance sheet has shrunk by over $1.5 trillion from its peak. Could the Fed start buying again? Theoretically, yes. But there's a problem: inflation. If the Fed starts printing money to buy government debt again, it risks reigniting inflation. Markets would interpret it as the Fed monetizing government deficits, which is exactly what happens in countries before currency crises. What about American banks? They're already stuffed full of Treasury securities, and they're sitting on massive unrealized losses. When interest rates rose rapidly in 2022 and 2023, the value of existing bonds plummeted. Banks that bought long-term treasuries at 2% now own assets worth far less than what they paid. This is what killed Silicon Valley Bank in March 2023. They held too many low-yielding treasuries, and when depositors wanted their money back, the bank had to sell those bonds at steep losses. American banks are not eager to buy more government debt when they're already overexposed. So we've eliminated Japan as a reliable buyer. They're selling. We've eliminated China. They're reducing holdings to multi-decade lows. Europe is stagnant. The Federal Reserve is tightening. Domestic banks are over-leveraged. That leaves what exactly? This is where the story becomes fascinating. Let's talk about what China actually wants, not what American politicians think China wants, not the caricature, the actual strategic objectives. China wants stability for its own economic development. The Chinese economy is facing significant headwinds: a property sector crisis, local government debt problems, demographic decline, reduced foreign investment. The last thing Beijing needs is global financial chaos. China wants recognition as a major power with legitimate interests. They want a seat at the table in global economic governance. They want the international system to reflect the reality that China is the world's second largest economy and largest trading nation. China wants to reduce its vulnerability to U.S. financial sanctions. After watching what happened to Russia in 2022, when Western nations froze Russian central bank reserves, every country on Earth started thinking differently about dollar dependence. If the U.S. can freeze Russia's money, they could freeze anyone's money. And China wants gradual de-dollarization, not catastrophic de-dollarization, a controlled shift to a multipolar currency system where the yuan plays a larger role, but where global trade doesn't collapse. Here's the beautiful irony. What China wants and what the U.S. needs are not incompatible. They're actually aligned if both sides can get past the political theater. The United States needs buyers for Treasury securities. China needs stable returns on its massive foreign exchange reserves, which stood at $3.2 trillion as of late 2025. The U.S. needs stable financial markets. China needs stable global growth for its export-dependent economy. The U.S. needs to avoid a sovereign debt crisis. China needs to avoid a global financial meltdown that would destroy demand for Chinese goods. The deal that's emerging isn't a formal agreement. It won't be announced at a press conference, but the contours are becoming visible. China will continue to hold substantial amounts of U.S. Treasury securities. They might not increase their holdings. In fact, they're likely to continue gradual reductions, but the key word is gradual, controlled, managed, not a panic dump. In exchange, there are implicit understandings. The United States will have to moderate its most aggressive anti-China policies, not abandon them, but moderate them. You can't implement a full economic decoupling while depending on Chinese capital. The contradictions are too obvious. We're already seeing signs of this. Despite all the tough talk, the Trump administration has been careful not to freeze Chinese holdings of U.S. treasuries. They couldn't. It would be financial suicide. The United States will have to accept China's growing role in international financial institutions, the expansion of BRICS, the development of alternative payment systems, the internationalization of the yuan. Washington can complain about these developments, but they can't stop them. And trying too hard to stop them gives China more reason to reduce Treasury purchases. The United States will have to recognize that weaponizing the dollar has consequences. Every time the U.S. uses financial sanctions, it reminds the world that dollar assets come with political strings attached. This drives long-term de-dollarization. So there's a tacit understanding. The U.S. won't use the nuclear option of freezing Chinese assets, and China won't use the nuclear option of dumping treasuries. This is not the kind of deal that appears in textbooks. It's a hostage situation where both sides are holding guns to each other's heads. And both sides are slowly realizing that maybe, just maybe, they should put the guns down. Let me give you concrete examples of how this plays out. Treasury Secretary Bessent understands this dynamic. He's a hedge fund manager. He made billions betting on currency movements and sovereign debt. He knows leverage when he sees it. His job isn't to score political points. His job is to sell bonds. And you can't sell bonds to people you're actively threatening. Meanwhile, Chinese officials have repeatedly stated that they view their U.S. Treasury holdings as investments, not weapons. Zhou Xiaochuan, former governor of the People's Bank of China, said in a 2023 interview that using Treasury holdings as a political tool would be self-destructive. That's diplomatic language for, we're stuck with each other. The alternative scenarios are worth considering because they show why this uncomfortable arrangement is better than the alternatives. Scenario 1. China dumps its Treasury holdings rapidly. This would cause U.S. interest rates to spike. Mortgage rates would shoot above 10%. The stock market, which is valued based on relatively low interest rates, would crash. The U.S. would enter a severe recession, possibly a depression. But China would also suffer catastrophically. The value of their remaining Treasury holdings would collapse. Their $689 billion would become worth far less overnight. The dollar would plummet, which means the yuan would surge, making Chinese exports uncompetitive globally. Chinese factories would close. Unemployment would spike. Neither side wins. Scenario 2. The United States defaults on its debt or restructures it. This has never happened in modern history with U.S. Treasuries. But let's imagine it. The global financial system is built on the assumption that U.S. government debt is risk-free. If that assumption breaks, every single financial model in the world becomes wrong simultaneously. Pension funds collapse, insurance companies fail. Banks that use treasuries as collateral suddenly have no collateral. The 2008 financial crisis would look like a minor inconvenience compared to a U.S. sovereign default. Global trade would freeze because letters of credit rely on trusted currencies and trusted counterparties. We'd be looking at a global depression that makes the 1930s look mild. Neither side wins. Scenario 3. The Federal Reserve starts printing unlimited money to buy all the treasuries that foreign buyers won't purchase. This solves the immediate funding crisis. The government can keep borrowing because the Fed will always buy. But this leads to hyperinflation. The dollar loses its value. Savings are destroyed. The currency that has been the foundation of global trade for 80 years becomes unreliable. Countries rapidly shift to alternatives. This scenario also ends badly for China. Their treasury holdings become worthless. But more importantly, the global trading system breaks down and China's export-dependent model collapses. Neither side wins. When you map out all the alternatives, you realize why the current uncomfortable equilibrium persists. It's not because anyone is happy with it, it's because every alternative is worse. This is what people miss when they talk about the US-China relationship. They focus on the competition, the rivalry, the conflict, and those are real. But underneath the competition is a layer of mutual dependence so deep that it constrains what both sides can actually do. The United States cannot afford to completely decouple from China because it needs Chinese capital. China cannot afford to completely decouple from the United States because it needs access to American markets and because breaking the dollar system too quickly would destroy value that China has spent decades accumulating. So what actually happens over the next few years? The most likely outcome is a managed transition. The United States will continue to run large deficits. Treasury will continue to sell bonds. China will continue to buy some of those bonds, but not as enthusiastically as before. Other buyers will be found, probably at higher interest rates. Interest costs will continue to consume a larger share of the federal budget. The Congressional Budget Office projects net interest will reach 14% of all federal spending by 2026. This will eventually force fiscal adjustments, either spending cuts, tax increases, or more realistically, a combination of both. The dollar will slowly decline as the world's dominant reserve currency. But slowly is the key word, not a collapse, but a gradual erosion. According to IMF data, the dollar's share of global reserves has already declined from 59% to 54% since 2022. The yuan will play a larger role in international trade, but it won't replace the dollar. We'll move toward a multipolar currency system with the dollar, euro, and yuan all playing significant roles. China will gain more influence in international institutions. The BRICS alliance continues to expand. The Asian Infrastructure Investment Bank and New Development Bank will handle more global development financing. The World Bank and IMF will have to make room. And through all of this, the public rhetoric from both sides will remain harsh. American politicians will talk tough on China because it's politically popular. Chinese officials will criticize American hegemony because it resonates domestically. But behind the scenes, Treasury officials and central bankers will maintain channels of communication because the alternative is too catastrophic to contemplate. This is the real deal. Not a grand bargain, not a dramatic announcement, just a mutual recognition that financial interdependence has created a situation where both sides have to cooperate on some level, even while competing on others. The tragedy is that this dependence was avoidable. The United States could have run sustainable fiscal policies. It could have invested in infrastructure, education, and productive capacity instead of fighting endless wars and cutting taxes during economic expansions. China could have developed robust domestic consumption and reduced its reliance on exports. It could have opened its financial markets faster and made the yuan truly convertible. Both sides made choices that created this mutual trap, and now they're both living with the consequences. For regular people watching this unfold, the implications are straightforward. The era of cheap money is over. Interest rates will remain higher than they were in the 2010s. This means mortgages are more expensive, car loans are more expensive, credit card debt is more expensive. It means the federal government will have less money for everything else because interest payments are consuming more of the budget. Infrastructure spending, social programs, defense, everything will be squeezed. It means the dollar will likely weaken over time, which makes imports more expensive. Your electronics, your clothes, your consumer goods, they'll cost more. But it also means the global economy is rebalancing. The unsustainable situation where one country could print money and the world had to accept it is ending. That's painful for Americans who benefited from that system, but it's arguably healthier for the global economy in the long run. The deal the United States is being forced to make with China isn't written down anywhere. You won't find it in a treaty, but it's real. It's happening every day in bond markets, in central bank decisions, in diplomatic meetings. It's a deal born of necessity, not choice. A recognition that two superpowers with fundamentally different systems and competing interests are nonetheless trapped together by financial mathematics. The United States needs China's money, not as much as it used to. But it still needs Beijing to not dump its holdings. China needs the dollar system's stability. They need global markets to function. Neither side can destroy the other without destroying themselves. So they'll continue this strange dance, competing and cooperating, threatening and negotiating, talking tough in public while making pragmatic accommodations in private. China continues to reduce its Treasury holdings, down 47% from peak levels. But they do it gradually, carefully. They increase their gold reserves instead. They build alternative payment systems. They prepare for a world with less dollar dependence, but they don't try to force that world into existence overnight. Meanwhile, the United States continues to borrow. 38 trillion and counting. The debt grows by 6 billion per day. Interest payments exceed 1 trillion annually. And Treasury Secretary Bessent continues to search for buyers, knowing that the biggest potential buyer is also America's greatest strategic rival. This is the new world, not the American century, not the Chinese century. The century of mutual dependence and constrained choices. The deal is already made. The world just hasn't fully recognized it yet.